Good day, investors. In this video, we're going to take a closer look at Petrobras stock, ticker symbol PBR. Petrobras has been a very generous dividend payer over the years, which has made it particularly attractive for dividend-focused investors. But the big question is that dividend sustainable? And with oil prices rising due to the conflict in Iran, could Petrobras actually benefit from the current geopolitical situation? In this video, we're going to break down Petrobras's business and financials, whether the dividend is sustainable, how higher oil prices could boost profits, and finally, whether the stock might be a buying opportunity today. But before we get into it, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming videos. Thank you very much. So first, let's take a quick look at what the company actually does. Petrobras is the state-controlled oil giant of Brazil. The company mainly focuses on three key areas: offshore deepwater oil production, refining petroleum products, and exporting crude oil globally. One of Petrobras's biggest advantages is its massive offshore pre-salt oil fields, which are among the most productive oil reserves in the world. These fields are located deep offshore Brazil and contain extremely high-quality reservoirs. In 2025, the company produced about 2.99 million barrels of oil equivalent per day, which represents roughly 11% production growth year over year. At the same time, Brent oil prices fell from about $80 per barrel in 2024 to roughly $69 per barrel in 2025, which was about a 14% decline. Normally, when oil prices fall like that, oil companies see their profits drop significantly. But Petrobras managed to offset that decline with record production growth. Looking at the numbers, adjusted EBITDA, excluding one-off events, came in at about $43.8 billion last year, compared to roughly $45.9 billion the year before. So despite lower oil prices, the company only saw a relatively small decline in EBITDA, which really highlights how resilient the underlying business is. Net income also remained strong. Petrobras generated about $19.6 billion in net profit, which is still an extremely solid result for an oil producer. And when we look at operating cash flow, Petrobras generated around $36 billion in cash from operations, which is also a very strong result. So even though oil prices declined significantly, Petrobras was still able to generate massive cash flow and strong profitability. The company is also well positioned for future production growth. Petrobras continues to invest heavily in developing its offshore oil fields, especially in Brazil's massive pre-salt region, which contains some of the most productive oil reservoirs in the world. New production platforms and wells are being brought online, which should gradually increase output over the coming years. For example, the number of offshore production wells that were started increased from 21 wells in 2024 to 44 wells in 2025, which represents a very significant increase in development activity. At the same time, the physical progress of offshore production platforms also improved substantially, increasing from about 72% completion to roughly 89%. All of this shows that Petrobras is continuing to expand its production capacity, which should support higher output and strong cash flow in the years ahead. The company also has very significant oil reserves, which provide a strong foundation for long-term production. As we can see here, Petrobras recently reported the highest level of proven reserves in the last decade. In total, the company now holds about 12.1 billion barrels of oil equivalent in proven reserves, which represents a very substantial resource base. Even more impressive is the company's reserve replacement ratio, which reached about 175%. What that means is Petrobras is actually adding more oil to its reserves than it is producing each year. And when we look at the reserves to production ratio, Petrobras currently has roughly 12.5 years of production already secured based on its existing reserves. So overall, Petrobras has a very strong long-term resource base, which supports the company's ability to continue producing oil and generating cash flow well into the future. Now, when looking at the future production targets, Petrobras is aiming to continue expanding its output over the coming years. The company is targeting around 2.7 million barrels per day by 2028, which would represent another meaningful increase in production. And reaching 2.7 million barrels per day would mean significantly higher oil volumes compared to today, which could translate into higher revenue, stronger cash flow, and greater earnings potential, especially if oil prices remain favorable. Now, while Petrobras is expanding its production capacity, it does come at a cost, which has increased the company's debt position. These offshore production platforms, also known as FPSOs, are extremely large and complex facilities, and building or leasing them requires significant capital investment. As a result, Petrobras's gross debt has increased somewhat over the past couple of years as these projects were developed. However, it's important to understand that these investments are directly tied to new production capacity coming online. In other words, the company is taking on some additional debt today in order to support higher oil production and stronger cash flow in the future, which ultimately supports the company's long-term growth outlook. So while the company is expanding its production capacity, it is also working to improve its cost efficiency and financial resilience. One way we can see this is by looking at Petrobras's break-even oil price, which is the oil price the company needs in order to cover its operating costs, capital investments, and financial obligations. As we can see here, Petrobras expects this break-even level to decline significantly over the next few years. In 2025, the company needed roughly $82 per barrel, but thanks to higher production and improved operational efficiency, that number is expected to fall to around $59 this year, and potentially about $48 per barrel by 2030. This means Petrobras should be able to generate strong cash flow even if oil prices are significantly lower in the future. Now, when looking at the operating costs, the current operating costs for the company are quite manageable, and importantly, a meaningful portion of these expenses can actually be controlled by management. Out of roughly $65 billion in total operating expenses, about $17.2 billion are classified as manageable operating costs, meaning the company has the ability to optimize or reduce these expenses if necessary. There are also about $2.3 billion in lease expenses, which together brings the total amount of manageable operating costs to roughly $19.5 billion. What this means is that Petrobras has multiple levers it can pull to improve efficiency and reduce costs if needed. Now, when looking at their capital allocation, Petrobras expects to generate roughly $190 to $220 billion in operating cash flow through 2030, assuming a Brent oil price of around $70 per barrel. A significant portion of that cash will be reinvested back into the business, with about $85 to $95 billion allocated to capital investments that support future production growth. At the same time, the company also plans to return a substantial amount of cash to shareholders, with roughly $45 to $50 billion expected to be paid out in dividends. The remaining cash will go toward leasing costs, new projects, and financial expenses, helping maintain the company's operations and growth strategy. So as long as operating cash flows remain stable, Petrobras should be able to both invest in future production growth and continue returning meaningful cash to shareholders. Now, when evaluating the dividend going forward, the key question really comes down to cash flow and capital allocation. As we can see here, Petrobras has reaffirmed a gross debt limit of around $75 billion, which helps maintain financial discipline. Over the past several years, the company has significantly reduced its debt levels, and today gross debt stands at roughly $67 billion, with projections suggesting it could gradually decline toward about $65 billion by the end of the decade. Importantly, a portion of this debt is related to FPSO leasing agreements, which are directly tied to new offshore production platforms coming online. So as long as Petrobras continues generating strong operating cash flow from its oil production, the company should have the financial capacity to both invest in future growth and continue rewarding shareholders through dividends. However, the outlook could become even more interesting depending on what happens in global energy markets. Now, if the Iran conflict were to turn into a longer-term geopolitical crisis, which is certainly a possibility, oil markets could remain tight for an extended period of time. That could keep oil prices structurally higher than the $70 assumption Petrobras currently uses in its projections. And if Brent crude were to stay closer to $90 or even $100 or more per barrel, Petrobras could generate significantly more operating cash flow than currently expected. Remember, the company produces roughly 2.4 to 2.7 million barrels of oil per day, so higher oil prices would have a very meaningful impact on revenue and profitability. Now, it's also interesting to consider what would happen if oil prices remain significantly higher than Petrobras's current assumptions. In the company's projections, Petrobras assumes a Brent oil price of around $63 in 2026 and about $70 per barrel for the following years. However, the company also estimates that every $10 increase in oil prices adds roughly $5 billion in operating cash flow per year. So if Brent crude were to average closer to $100 per barrel instead of $70, that would represent about a $30 increase in oil prices. Based on Petrobras's own sensitivity estimates, that could translate into around $15 billion of additional operating cash flow per year, and roughly $18 billion of additional cash flow this year alone. Over the full planning period, that could increase Petrobras's total operating cash flow from roughly $190 to $220 billion to potentially around $270 to $300 billion. And that additional cash flow could support larger dividends, faster debt reduction, and even more investment into future production growth. So the final question is Petrobras stock a buy right now? Looking at the fundamentals, Petrobras still appears very attractively valued. The company currently trades at a PE ratio of around 6 and a forward PE of roughly 7, which is extremely low compared to many global oil companies. At the same time, Petrobras generated about $90 billion in revenue over the last 12 months and nearly $20 billion in net income, showing just how profitable the business can be when oil prices remain supportive. Investors are also being paid to wait. The stock currently offers about a 5.8% dividend yield, and depending on oil prices and cash flow, that dividend could potentially increase. Now, of course, there are risks, including political influence from the Brazilian government and volatility in oil prices, but Petrobras also owns some of the most productive and lowest cost offshore oil assets in the world. So when you combine strong cash flow, a low valuation, growing production, and a solid dividend, Petrobras could still be an interesting opportunity for long-term income investors, especially if oil prices remain elevated. If you found this video helpful, remember to leave a like for the YouTube algorithm and subscribe to the channel for more upcoming videos. And as always, remember to do your own due diligence before making any investment decisions. Thank you for watching and happy investing.